If you are in your 30s right now and you want to retire a millionaire, there are two things you have to do. Number one is you have to figure out how far you are from becoming a millionaire. And number two, you have to put a plan in place to actually become a millionaire. Notice how neither one of these two things require you to go out and get lucky or win the lottery. See, what most people do when they decide that I want to go and become wealthy or I want to become a millionaire is they try to figure out how much money should I have saved up right now and how far am I from what everybody else is doing. And this is what Fidelity has put up on their website. According to Fidelity, if you want to retire comfortably by the age of 30, you should have 1 times your salary, meaning if you make $50,000 a year, you should have $50,000 put away. By 35, you should have 2 times your salary. In this case, that'd be $100,000. And by 40, you should have 3 times or $150,000 put away for retirement. This might give you a start, but I'm not a big fan of this type of vanity information because the reality is it doesn't really do you any good. Number one, it doesn't tell you what you should be doing with that money or how fast your money is growing or how you're growing your money or if your money is paying out any cash flow. It just tells you how much money you should have put aside. And second, it doesn't give you any indication of how you're going to be living your life. It just says that if you want to be an average 35-year-old, this is how much money you should have put aside. But if your goal isn't to be average, if your goal is to become wealthy, if your goal is to go out and become a millionaire, well, then you're going to have to think a little bit different. And that's why today, if you stick with me till the end, I'm going to go over 4 different steps of now how you can actually make it happen, how you can actually become a millionaire with actionable steps. Step number 1 is you're going to have to calculate how much money you're going to actually need to retire or be wealthy. Second, you're going to take a look at how much time you have ahead of you to stack and grow your cash. Third, based off of what we answered for number 1 and number 2, you're going to put a plan together on how you can actually retire and become a millionaire. And this is where most traditional financial planning ends. But because we are the minority mindset, we're going to take it a little bit further. And now we're going to also think about number 4, which is think bigger. How can you become even wealthier and live an even bigger lifestyle? Now, I got to give you a little bit of a disclaimer. I am not a licensed financial advisor. I'm just a random guy on YouTube. Everything that I talk about in this video and all of my other videos are for educational purposes only. So if you have specific questions, talk to a licensed advisor in your area. Let's dive into this, starting with number 1. How much money will you actually need? Is $1 million enough? Now, the most common way that people like to go about doing this is by using something called the 4% rule, which says figure out how much money you will need today based off of today's dollars, divide that number by 0.04 or 4%, and that's going to give you a total amount of money, a lump sum amount of wealth that you need put aside. That way then you can draw out the amount of money you need, and then you'll have enough money hopefully to last you the rest of your life. So as an example, let's assume that you need $50,000 a year in today's dollars to be able to live your life financially free. If you follow the 4% rule, that means you take that $50,000 divided by 4% or 0.04, and that tells you that you would need $1.25 million today to be able to retire, assuming you were entering retirement right now. So now, if you needed $1.25 million in order to be able to live your life, that means then you could draw $50,000 right now, and then next year you could draw a little bit more than $50,000 based off of whatever inflation is. That way now you don't have to worry about money. You have this nest egg put aside that you can use to live your life. This 4% rule works for a lot of people. It's just not something that I personally like or that I like to use because it follows a traditional retirement idea where now you're going to have to work until you're 65 or 67 or 70 years old. And then once you have enough money put aside at that age, now you can pull money out of your account. And the second issue that I have on it is, well, your account, your bank account or your investment account is going to keep getting smaller because the whole idea behind this type of investment and investment planning is you're going to keep pulling money out. You're going to keep either selling your investments or pulling cash out of your savings account. That way now, every time you use money, every time you spend $1, your bank balance is going to get smaller and smaller and smaller. I'm not a huge fan of that. That's why when I like to look at numbers, I like to look at it from a cash flow perspective, which is, can I build a machine, an asset that's going to spit off enough cash flow for me to live my life? So now going based off of the same numbers, if I need $50,000 a year to be able to live my life, what can I do or how can I have enough cash flow from my investments to pay me that $50,000 a year? Which means the question now becomes, how many assets or how much money do I need to invest in order to get this $50,000 with the cash flow? Now I'm going to get this $50,000 year after year after year. And if I do it correctly, it will also adjust for inflation, meaning when inflation happens, the cash flow that I get will also increase. But the difference here is I don't have to sell any of my investments to get this cash flow. because now I own the right type of investments. I'll explain exactly what that means later on in this video, but I own the investments that are paying me with the cash flow. So now I'm getting the money without having to sell anything. And then I have these assets that will continue to pay even after I die. So they can take care of my family, they can take care of next generations, and I can do whatever I want with these assets. For me, that's much more attractive, but you got to figure the right option for you. So now when you do this cash flow model, you're going to do it a little bit differently. Now, instead of just taking the amount of money that you need and dividing it by 0.4, what I like to do is you take the amount of money that you need, in this case, $50,000, and then you're going to divide it by two numbers. First, you're going to divide it by 0.03 or 3%, and then you're going to divide it by 0.07 or 7%. The reason why is because the amount of cash flow that you're going to get is going to be a range. You can comfortably get somewhere between a 3% or 7% cash on cash yield, meaning a 7% or 3% cash on cash return, cash flow on your investments. So if you can get somewhere between a 3% and a 7% cash flow, the question is, how much cash do you have to invest in order to get that cash flow? So if you need $50,000 on the high end, you take $50,000 divided by 3%, which would mean you'd have to put aside $1.66 million at a 3% cash flow to be able to generate the $50,000 a year. Now, on the other end, the lower end, if you can get a 7% cash on cash return, well, now you would have to invest $715,000 based off of the 7% return, the 7% cash flow to get that $50,000 a year. So now you have this range. You'd have to put aside between $715,000 and $1.66 million into the right investments to generate enough cash flow to live your life. The second thing that you got to do once you figure out the money side is you got to figure out the time side. If you are 35 years old right now, how much time do you have ahead of you to build this wealth? Is it 30 years? Are you going to work until you're 65? Is it 35 years? Is it 40 years? Let's just assume now that you're 35 years old and you have 30 years ahead of you and you have $0 put aside for your wealth, for your investments, and you want to put aside $1 million to get the cash flow or the wealth that you will need to be financially free. That means between now until 65, you have 30 years to put aside $34,000 a year to put aside that $1 million. I'm going to jump back into the video in just 1 second, but before we do, if you are an investor and you're looking for an easy and free way to stay up to date on what's happening in the top financial news, from the economy to the housing market to the stock market to the crypto market to the global economy, then you have to check out Market Briefs. Market Briefs is my free financial newsletter that I created that will keep you up to date on what's happening in the financial news. You can read the newsletter in less than 5 minutes every morning. It's a fun and easy to read email, and it's completely free. So if you haven't joined Market Briefs yet, I got the link to how you can join down in the description below. Now, depending on how aggressive you were in your 20s, either this is going to be very accessible or it's going to seem like it's impossible, which then brings us to step number 3, which is how do you make a plan to actually make it happen? Because the reality is, at this step, you have to actually figure out how you are going to make it happen, because it's easy for anybody to say, okay, I got to put aside $10,000 a year or $30,000 a year or $50,000 a year. And now when you hear that, you're going to either have the reaction of, that's impossible, I might as well just give up now, or you're going to have the reaction which is, okay, that's pretty doable, I don't got to change too much. And this is where now you have to put a plan together of how are you going to actually make it happen. Because the reality is, let's just be logical now, there are two ways you can put more money aside towards your investments. Number 1 is you can spend less, or number 2 is you can earn more. So if you make $50,000 a year, there's going to be a limit to how much you can cut back on. If you have the ability to live off of $40,000, that means now you have $10,000 that you can put aside for your investments and your savings. If that is enough money for you to achieve the goals that we just calculated, okay, go ahead. If it's not enough money, well, now you have two options. Either you live off of $30,000, that way you can put aside $20,000, or you're going to have to work to earn more money. And this is where you're going to have to be honest with you. Now, one thing that I do want to kind of really highlight here is there is a limit to how much you can cut back on. There's a limit to how many vacations you can not go on. There's a limit to how many restaurants you don't go out to eat. There's a limit to how many shoes you don't buy. There's a limit to how many birthday parties you don't go to. But there's no limit to how much money that you can earn. So this is where you got to find the right balance for you. The most accessible thing, not the easiest thing, but the most accessible thing is to start cutting back on your expenses. And this is where everybody needs to start. You have to start by cutting back, because if you do not know how to control your spending, it does not matter how much money you make, you're going to always be in a financial hole. So you got to start by being able to cut back on your spending. Once you do that, this is where now you got to figure out how are you going to earn more money. And the most difficult thing that I've seen for people in the 30s is you feel like you are stuck in one particular career path. You've been working at something for 10 years now. You got a degree, maybe you went to grad school to do this particular thing, accounting, engineering, whatever it might be. And now you are so ingrained in this one particular career because you've built your reputation, you built your name, you built some networks, and you've worked your way up in this career, and you're kind of slowly just moving your way up the ladder. But if you're not fulfilled, either financially or emotionally or spiritually in what it is that you're doing, it is never too late to make a change. And this is so hard, I feel like, for somebody in the 30s, because you're kind of in that middle stage where on one hand, you're just starting to really see that success that you've been working hard to achieve. And then on the other hand, it's, do I want to continue doing this my whole life? Because when somebody gets older and you start to really make that financial success, at that point, you're like, you know what? I don't have too much time ahead of me. I want to live my life now, and I don't really care what's going on. I'm just going to do something different. You start to see that a little bit later, whether it's in the 40s or 50s, maybe even 60s. But in that 30s, this is when a lot of people are really starting to see the success. You're grinding, you're putting in the work. And to make a change now feels like you're starting back at your 21s or your 22s or your 23s. But the reality is time is going to go on no matter what. And if you're spending your time doing something that you hate, that's not giving you the fulfillment, that's not giving you the financial success that you want, it is never too late to change. Now, this doesn't mean you have to go and quit everything that you're doing now and start doing something completely different. But you can also do something on the side. There are 24 hours in a day. The question is, what are you doing in these 24 hours? You got to sleep. Let's put aside 8 hours for that. You got to work. You have another 8 hours for that. Well, now, that was 16 hours for your sleep and your work, which leaves you another 8 hours. Now you got to spend some time with your family. You got to spend some time doing your gym, your exercise, everything in between. But you still got a little bit of time left over. Now the question is, what are you doing with that extra time? Are you using that time to watch Netflix, to go on TikTok, to go out and just waste time enjoying your life right now, being comfortable? Or do you want to use that time to start learning a new skill? And if you are not able to get to where you want to go financially based off of the numbers that you're seeing right now, this is the time for you to go out and do something different. It is never too late. When I talk to my friends, because I have a lot of conversations with my friends about this, I want to grab them by their shoulders and shake them and tell them, dude, you're 35 years old. You are young. You got so much time ahead of you. It's okay to start over. It's okay to do something different. It's okay to do something in addition to what it is that you're doing right now. But you have to actually want to do it, and you got to put in the work to do it. Go out and start watching YouTube videos about whatever it is that you want to do. If you want to start a business, there are millions of videos out there that will help guide you, that will teach you different things. Start reading books. Start learning. That's the first thing I want you to do. In that extra time that you have right now, first start by learning. Read books. Watch YouTube videos, listen to podcasts. You don't got to spend any money right now. Just go out and start using your time in a way to start learning. Then I want you to try something. Whether it's going out and becoming a freelancer, you're working for somebody else's business, whether it's going out and becoming a contractor, working for somebody else's business inside of their business, whether it's going out and getting a second job, even as an intern, an unpaid intern at 35. Yes, I am saying that you can do that. To start learning, because we're doing this not to earn, we're doing this to learn. Once you learn, then you can earn. But right now you got to learn, go out and get those skills, and then start applying it to yourself. Maybe that means you go out and create something. Maybe that means you go out and start a side business. Do something on the side until you're able to do it full time. And by do it full time, I mean financially. When you see the financial opportunities, not just, oh, I think I can make a lot of money doing this, but when you see the money coming through the door, that's when I want you to start pivoting. And the biggest mistake that I see people make is you assume that you have to start spending money in order to start making money. And the simplest example I can give you of this is of starting a YouTube channel. Anytime I hear somebody that I know or in my network or in my network's network starting a podcast or YouTube channel, the first question everybody has is, What audio equipment do I need? What camera equipment do I need? What lights do I need? How much money do I need to spend to start doing this? But that's the completely wrong question. If you go into the game thinking that the equipment that you have is going to make your business, make your brand, make your creative, make your content, you are completely wrong. It is the content that is going to make or break your brand. What I tell everybody in that situation is if you want to start a content business, you want to start a YouTube channel, great. Start recording videos on your iPhone, period. Don't spend a penny until you start making money. It's the same in any business model. You got to figure out how to make a dollar before you start going out and start spending dollars, because people start spending money in every business. It's not even just the content business. People start spending money thinking that if I start spending money now, it will fix the actual problems in my business. When in reality, what you need are sales, you need customers, you need leads, period. That's where all your focus and energy should be going. It breaks my heart when I see businesses spending all their money on having the nice furniture and having the nice office before they have the sales come in. One of the painful memories that is scarred into my brain, this is a number of years ago. I used to do a little bit of business consulting here and there. And there was a company, a startup company, that had raised hundreds of thousands of dollars. They had won a bunch of incubators, a bunch of business competitions. They had raised a ton of money. And the founder of the business reached out to me and said, Jaspreet, I would love for you to potentially work with us or see what was going on, just kind of help consult us. So I didn't really know what I was going to do. I went to the company, went to their office, which was an amazing office. They had these really cool wooden floors. They had these glass offices, conference rooms. And I remember this so vividly because there were people literally riding the rollerblades in the office from one end to the other. And I was like, this is really cool. Like, this is that startup cool culture. Like, this is awesome. And I met with the founder. We go into her office. She sits me down and starts showing me the numbers. And immediately, I had this confused look on my face because nothing was making sense. Number one, they were barely making any money. And number two, they were losing money on every sale that they generated. Now, I'm purposefully not giving a lot of details as to the name and the products. But the first question I had was, what's going on here? How are you losing money on every single sale? And her whole pitch was, we're spending $2 to make $1 because that's what my marketing professor had taught me. This is what I learned in my marketing class. And I said, okay, this makes sense to an extent. When you raise venture capital, you can use the outside money to grow at a loss, but you have to have the ability to, at some point, become profitable. And this was the conundrum that they were running into right now, that the investors, they don't want to put in more money until they could see that this company was going to become profitable. So the question was, how did it become profitable? And so this is when now we started going back and forth. And I was like, you have so many unnecessary expenses. I just started looking around the office. They had all the fancy furniture. You had all these cool things, all the cool benefits, but none of the real stuff. And this is where now, if you want to make more money, you got to focus in on the stuff, not the fluff, but the stuff. What is the thing that is going to make you money? Is it producing more videos? Is it getting more customers? Is it doing what? What is going to make you money? Focus on the money. If it does not drive you more money, stop wasting your time on it. It's not about the clothes that you wear. It's not about the watch that's on your wrist. I don't even got my watch on me right now. It's not about which camera that you're using. It's not about what lights that you're using. There are so many videos that I still record today with over 1.6 million subscribers that I still record videos off of my cell phone. This video is not, but a lot of videos today are still recorded off of my cell phone if I'm traveling, when I'm going out places, because it's just convenient. And iPhones have really advanced. And so it's not the equipment that will make or break you, but it's the product. And it's how lean can you be. And this is where so many people get caught up, is they start spending money before they start earning money. And when you start spending money, now this business, this idea, this whatever becomes a money suck. It becomes a money pit. It becomes a black hole. because you think that the fancy sofa, the fancy office equipment is what is going to make you successful. You think that having motivational posters around your office, the $100 motivational posters, are going to get you motivated to get to work. When in reality, what you need is an alarm clock to get you up and to work. You got to do the things that will actually make you money. And this is where now, okay, going back to the numbers. If you need more money to be invested, you got to earn more money, period. How can you earn more money? Now, again, you can go back to your job, see if you can get a raise, see if you can get a promotion, see if you can get a bonus. You could look into getting a second job, getting a part-time job. If that's not going to cut it, then you're going to have to work to create your own income. If you're going to create your own income, it is going to take risk. It is going to take sacrifice. It's going to take time, and it's going to take work. Nobody is going to build $1 million business overnight. And unfortunately, the internet makes it seem the complete opposite, that you can follow these 6 steps, pay $1,000, and learn how to build $1 million business in 6 months. It does not work like that. It takes years to build $1 million business. And the people that you hear about building these overnight $1 million businesses are people that have been in the game for a decade. They've learned the ropes. They've learned advertising. They've learned marketing. They've learned sales. They've learned product development. They've learned people management. Building those skills take time. And unless you have that 0.0001%, you essentially hit the lottery where your first product goes viral and you get thousands of sales right off the bat. It is going to take time. And most people don't have what it takes to put in that effort. Building a business is just like building wealth. It takes consistency. It takes that sacrifice. It takes that skill of being able to work for the long term. Because most people, when they want something, they want it today. We have this microwave culture right now, where when I want something, I want it now. When I want something, I want it today, even if I can't afford it. I remember when the post-pandemic boom was going on. I was living in Chicago during that time. Chicago is a very beautiful city, one of my favorite cities. And in Chicago, there is a street called Michigan Avenue, which is their main shopping street. All the nice stores you can think of, Gucci, Louis Vuitton, Burberry, they're all on Michigan Avenue. And I would go on walks with my wife down Michigan Avenue. This is after the 2020 pandemic. The 2021 economy is happening right now. And there were lines out the door, sometimes around the block, for every single name brand store. Gucci. Sometimes there were 2-hour waits on a Wednesday afternoon. 2-hour waits to get into Gucci on a Wednesday afternoon. And I looked at my wife and I said, something is going to break. This doesn't make any sense. First off, if somebody has the money to buy Gucci, you got to be earning. And I'm talking about not just buy it, to be able to afford it. Because anybody can buy Gucci. Anybody can go out and get a 0% APR credit card and buy Gucci. What I'm talking about is to be able to afford comfortably a $3,000 handbag. I don't even know how much they cost. I'm just going to assume they cost $3,000. If you want to buy a $3,000 handbag comfortably, you need to be able to make decent money, because now you got to, 1, make enough money to pay your bills. Number 2, put some money aside for your investments. Number 3, put some money aside for your savings. And then 4, have the disposable income to go spend thousands of dollars on a handbag. And then on top of that, you got to have the time to wait in line for hours to go and get this handbag. There was people around the block doing that. Now, I don't want to judge, but I just assumed that a big chunk of the people standing in these lines did not have the ability or the means to comfortably afford these handbags. And so what is happening? Well, people were going into debt to buy these handbags, or people were sacrificing their future wealth to buy these handbags. Now, don't get me wrong here. I'm going to emphasize this again. I have no issue with somebody buying Gucci. I don't like Gucci. You might like Gucci. That's fine. I don't care. If you want the nice things, I want you to have the nice things. If you get enjoyment out of being able to afford and have the nice stuff, go out and get it. Get whatever Gucci, Rolex, Louis Vuitton. I don't care. Get all of that stuff. I just want you to be able to afford it first. I don't want you to sit here sacrificing your wealth sacrificing your financial well-being, sacrificing your kids' college fund, just so you can have a name brand purse around your waist or a name brand belt around you. I want you to focus on your wealth. Make yourself rich first. And this is where we live in a consumerism society. We live in a consumerism culture where it is taboo, it is bad, it is cancel culture to call somebody out for being dumb with their money. When the reality is, if you are dumb with your money, you are going to pay the price. Maybe not today, maybe not next year, but eventually you're going to pay the price. And then when you pay the price, what does that mean? Well, you racked up credit card debt. You spent money on things that you shouldn't. You bought a whole bunch of things that you shouldn't, that you couldn't afford. And now you run into problems. Why? Maybe the economy slows down. Maybe you lose your job. Maybe you spend too much money. Something happens and now you run into financial problems. And then what happens? Now you're upset at your boss. Oh, my company went under. Or you're upset at the government. I need more assistance. The economy is going down. And then this creates this vicious cycle of constantly blaming somebody else. And you know what? You're right. There's always somebody to blame. There will always be somebody to blame 100% of the time. You can look at any recession, any bad thing that's ever happened. There's always somebody to blame. But blaming won't fix your problems. Pointing fingers will not fix your problems. Calling somebody else out won't fix your problems. Screaming, kicking, complaining, crying is not going to fix your problems. If you want to fix your money problems, that means number one, you got to figure out how to control your spending. And then number two, you got to figure out how to earn more money. Period. We live in this society where consumerism, overspending on things that you do not need, that you cannot afford with money that's not yours, is completely normal. There was this whole movement of people called Henrys, high income earners, not rich yet. Of people talking about, I'm making $100,000 or $200,000 a year and I want to live my life traveling, so I don't have the ability to invest or save or do all that stuff yet. It is a completely normal system for people to brag about how much credit card debt they have, for people to brag about their car payments, for people to brag about spending money on things they cannot afford. It's normal. Just look at Instagram. Instagram is a whole reel. It's a whole box full of people showing off stuff that they cannot afford. This is our culture. Now, what I'm saying is, who cares? Build that minority mindset and think a little bit differently. If you want to do and have what other people don't have, you're going to have to start doing and thinking the way that most people are not thinking. Because if most people are going into debt with buy now, pay later, 0% APR credit cards to buy the nice stuff right now, that means you got to do something a little bit different. And that means you might have to make bigger sacrifices than other people are making. That means you might have to put in harder work than other people are making, especially right now. Now, you might not see the success in 6 months, maybe not even 6 years. But if you stay consistent, you're going to live a whole lot more financially free, because you're going to have the ability to live your life without having to stress about money. And when you live a life of just trying to keep up with everybody else, when you live that life of just constantly trying to flex on Instagram, when you live that life trying to just buy all the nice things because everybody else is doing it, eventually it's going to catch up to you. And either it's going to catch up to you because one day your credit card company is going to deny your next payment because they're going to say you spent too much money, or it's going to catch up to you because something's going to happen to the economy, or something's going to happen to your company. And now all of a sudden you realize you were just one paycheck away from being broke. And yeah, you were living high, you were living great, everything was fine until reality kicks in. And this is where now it is your job to make sure reality kicks in right now before your credit card company, before your boss, before the economy kicks your face with it. Because then everybody starts complaining. When you see a recession happens, why are so many people always upset and angry? Because most people didn't expect it to happen. People didn't have the right savings. People didn't have the right investments. People didn't plan for it. But what happens in the public eye, into the media eye, is greedy corporations ran their businesses into the ground and now I lost my job. Yes, that happens. It's a fact. We've seen it happen pretty much every decade for the last century. But the next part of that is, if that happens, how do you protect yourself? This is now you being financially smart and taking care of yourself, because the reality is if you rely on everybody else, you rely on the government to take care of you. If you rely on a corporation to take care of you, if you rely on somebody else to take care of you, you are going to be the one that's subservient to them. And this is where now you got to take your financial future and your family's financial health into your own hands. And I get it. We all want to live in this utopian world where everybody's looking out for one another. That's great. It should be your duty to become successful so you can take care of other people. That's the way that I look at it. I want to make more money so I can take better care of my family, so I can take better care of my community, so I can take better care of myself. It is your duty to make more money so you can take better care of the community and your family and yourself. But if you're just constantly relying on everybody else taking care of you, and then something breaks in the system, which happens, recessions happen, companies go bankrupt, things happen, and you're not prepared for things to happen, well, then that's what creates the anger, the resentment, the frustration, and just the constant confusion and this spinning of the wheels and constantly just blaming. The reason why I'm broke is because my company went under. The reason why I'm broke is because my boss sucks. The reason why I'm broke is because the government sucks. It doesn't do you any good. It's always, the issues are always going to be there. But this is where now you, as a financially smart individual, need to start planning, and you need to figure out what is it actually going to take. So now, put the plan into place. You know how much money you need in order to be able to retire wealthy. Is it going to be that lump sum amount, or are you trying to build cash flow? If you need more money in order to get there, how are you going to go out and earn more money? Because now it is your duty as a financially smart person, as a financially educated person, as a financially independent person to go out and get that money. That way you can take better care of yourself, so you can take better care of your family, so you can take better care of your community. Now, it's where do you put that money? And I'm going to talk about that in just a second. But this is where I want to talk about the fourth point, which I was mentioning, which is thinking a little bit bigger. Because most people are working towards the traditional aspect, traditional idea of retirement, which is I'm going to work until I'm 67 years old, quit my job that I hate, and then start living my life. It is such a dumb idea and attitude towards retirement and work. Because there's a saying that goes, those who retire early die early. And I have seen this happen firsthand. One of my uncles, he was an engineer, wasn't actually related to me, but I call him my uncle because he's in Indian culture. You call everybody your uncle. He's my dad's friend. He used to work as an engineer. He worked as an engineer for many years, decades. He retired at 65 or 66, and then he had nothing to do. He sat at home watching TV, and then he essentially begged his company to take him back. His company took him back for about another 9 months. He worked there for 9 months, was happy, everything was good, and then his company let him go again because they were finished with whatever contract he was working on. Then he went back home to his sofa with nothing to do, and immediately his health suffered. His mental health suffered. He went from being this healthy person with not a single health issue to having everything wrong. He became depressed. He had so many physical health issues because he had no purpose anymore. He used to get up every morning to get ready for work, and that was something he looked forward to. He enjoyed, to some extent, his work, but he enjoyed the fulfillment that he got out of his work. And so now, if you really want to be fulfilled financially and spiritually, you got to figure out now, what is it that retirement is going to look like for you? I call it lifestyle design. What type of lifestyle do you want to live? People ask me, what are you going to do in retirement? And it's one of the dumbest questions that I get. I don't plan on retiring. This is what I want to do. I love the idea of spreading financial education. I work all the time. I work 7 days a week. I work when I'm on vacation. Not because it feels like work, but because it's something I enjoy doing. I feel weird when I'm not working. This is something that's fun to me. And so now it's, what is the type of lifestyle that you want to live? And when you can find the type of lifestyle that you want to live and blend it in with your work, well, now you have much more ability to, number one, do something that makes you feel much more fulfilled, gives you that sense of purpose, and spiritually makes you feel happier. But then second, when you do something that you care about and that you love, you're going to have the ability to make way more money financially, which means now instead of working for that $1 million, now maybe you'll have 10 million, 15 million, 25 million, 50 million, $100 million. There's no limit because most people are working for that type of retirement where it's how much money do you need to be comfortable? But if you really want to live different, maybe you don't want to live comfortable. Maybe you want to live big. Maybe you want to fly in private jets and drive Rolls Royces. It's not going to happen with $1 million. And it is possible, despite what a lot of people say, despite how you grew up, despite who your parents are, despite what your skin color is, despite what your first language is, despite where your family's from, it is possible. But you have to, number one, believe it's possible. Then number two, put in the work to actually make it possible. And this is where now it's, how big are you thinking? And I'm going to tell you from personal experience, I have this hard head where I always thought big. People always made fun of me for thinking big. But when I first started this YouTube channel, the Minority Mindset YouTube channel, I remember thinking to myself that if my channel ever got 100,000 subscribers, I would be on top of the world. Like that would be a win. Like that would be it. 100,000 subscribers, because that would mean that 100,000 weirdos had to go out of their way to subscribe to this financial education channel. And people don't like learning about money. And I remember telling some of my friends that if my channel ever grew to 1 million subscribers, I knew that was never going to happen. I said, if my channel ever grew to 1 million subscribers, I'm just going to shut my channel down as a joke. Now, here I am today with over 1.6 million subscribers, which is, now looking back, how and why was I so doubtful of myself? And I'm one of those people that I thought big. So now when I think of new business ideas and new projects that we're trying to run, I'm trying to always think bigger and bigger, to the point where unless somebody's laughing at my idea, unless somebody says what we're doing is too crazy, it's too broad, it's too big, it's not big enough. And this is where now what I want you to think about before we get into the how-tos of actually putting your money to work is, are you thinking big enough? Because if you set your goals here, it's going to be very hard for you to break that goal. But if you set your goal much higher, maybe you won't hit your goal, but you'll get a heck of a lot higher than you would be if you just set your whole goals down here. So think about how big you want to live. If you are in your 30s and you want to figure out how you can start investing, it is not too late, but you need to get started ASAP, because there are 3 factors that will determine how wealthy you will become. Number 1 is how much money you invest. Number 2 is the return that you get on your money. And number 3 is the time, meaning how long that you can invest your money for. So for example, if you invest $300 a month and you can get a 10% annual return on your money, and you do this for 30 years, you might be able to retire with $650,000. But now let's change it up a little bit. If you can invest the same $300 a month, you get the same 10% annual return, but now instead of 30 years, you invest for 35 years, now you'll be able to retire with over $1 million. Now, the one thing you can't do with time is go back. You can work on increasing how much money you invest by working to earn more money, and you can increase how much return you get depending on how you invest your money in your financial education, but you cannot change how much time you had ahead of you. This is where now it is so important to get started today. And that's why I want to go over a couple different investing strategies that you can start considering. Now, again, I am not a licensed financial advisor. If you have questions, talk to a licensed advisor in your area. But there are 2 general categories of investments that you can make, especially in the United States. Number 1 is by using a tax-deferred retirement account. And number 2 is by using a taxable retirement account. A tax-deferred retirement account would be doing something like a 401k, a 403b, a 457b, or an IRA. Now, for all intents and purposes, a 401k, 403b, 457b all work essentially the same, and I'm going to lump them all together, and then I'm going to talk about the IRA. The whole idea behind these tax-deferred retirement accounts is you're going to get a couple benefits. Number 1 is you get the benefit of getting some tax deferrals, and number 2 is you get the potential benefit of an employer matching your investment. Meaning, if you put $1,000 into your 401k, your employer might give you an extra $250, maybe an extra $500, maybe an extra $1,000 just for contributing money into your 401k. So if you get that benefit of an employer match, there's a lot of powers, kind of like free money that you're getting by doing that. But there's a lot of cons with 401ks and IRAs, but I'm going to get to that a little bit after. But this is a great place to start, especially for a beginner investor. If your goal is just to build up this retirement fund, start by putting the money that your employer is matching. So if your employer is matching you up to a certain amount, do that at least to get started, and then you can decide later on if this is something you want to continue with or not. But get started at least with that employer match. Now, the whole idea between the idea with a 401k or an IRA is you get this benefit of being tax deferred. And what that means is either you can pay taxes today and not pay taxes in the future, or you cannot pay taxes today and then pay taxes in the future. So if you go out and you get a traditional 401k, you don't have to pay any taxes today on the money that you invest. So if you got paid $1,000, you put all $1,000 into the 401k. It's a traditional 401k. You don't have to pay any taxes on the $1,000 that you invest. On all the rest of your income, you got to pay taxes on it. So now instead of paying, say, $200 in taxes, you get to invest all $1,000. Now this $1,000 can grow over the course of your career. And then when it comes time for you to retire at 65, 67, 70, however old you might be, now you get to pull this money out. Because you started with more money, the goal is that you're going to have a bigger nest egg because you don't have to pay any taxes in the beginning. But then on the back end, you're going to have to pay taxes when you pull this money out. So if that $1,000 becomes $2,000, now you got to pay taxes on all $2,000. Now the question is, how much are you going to pay in taxes? And this is where it's a little bit of a question mark, because on one hand, the idea, the thing that everybody says is you are going to have less income when you retire, so your taxable income is going to be lower, right? Because we have a marginal tax rate. The more money you make, the higher tax rate is. And so everybody says, well, when you're 65 or 70 years old, you're not working, so you're not going to have a lot of income, so your income is going to be lower, so your tax rate will be lower. On the flip side, you don't know what the tax rates are going to be when you're 65 or 70 years old, because, well, there's a good chance that tax rates could potentially go up. Why? Because number one, the United States government has a massive amount of national debt. Number two, we're still running a pretty large government deficit, meaning we're spending more money than we're bringing in. And so all these things could contribute to the government needing more tax dollars in order to continue funding their operations. And the third thing, which is probably one of the biggest factors for me, is why would I want to have less income when I'm older? If I work to build my investments correctly, I'm going to have way more income in the future because I'm working, even if it's not my own business. I'm going to just assume that I don't have a business right now. I'm going to be working to stack my investments, to stack my cash flow. Every year, I'm working to build more and more and more cash flow. I am buying more cash flow producing assets year after year after year, which means by the time I'm 65, I'm not hoping I'm going to have no income. I'm hoping I'm having a lot of income, which means I would have a big taxable income. Now, that's me. You got to figure out what is going to be the best situation for you. That's how a traditional IRA or traditional 401k works. The Roth is a little bit different. With the Roth, if you wanted to invest $1,000 into your 401k or IRA, the first thing you're going to do is pay taxes on this money. So if your effective tax rate is 20%, you make $1,000, put $200 to the IRS. Now $800 gets invested. Now with this $800 gets invested, this money can grow. And if it again doubles to $1,600, now you get to pull this money out generally tax-free. Now in the other example, you got to pull out $2,000, but then had to pay taxes on it. In this case, you pulled out $1,600, but don't have to pay taxes on it. And the question is, which one is going to be better for you? Would you rather have $1,600 tax-free or $2,000 that's taxable? And this is really a question of personal preference because, again, we don't know what tax rates are going to be in the future. Are they going to be higher or are they going to be lower? And second, what is your income going to look like? Are you planning on having way more income in the future, or are you planning on having less income in the future? That's the first question you have to ask for yourself. The second thing, when it comes into the actual how-tos of investing in your 401k or your IRA, is where can you actually invest your money? When you invest your money into a 401k, a company-sponsored retirement plan, you're generally, especially if you're working for a smaller company, going to be limited to where you can invest your money. So you're going to have generally limited investment options, And sometimes you might be stuck into paying really high fees for your investments, which means if you are somebody who likes managing your investments, you like investing your money yourself, you might not have the same investment opportunities. You might have to pay higher fees. You might not have the same return potential as if you invested this money yourself. So this is where, again, I'm not saying don't go out and do this. Get started. This is an easy way for you to get started with your investments. And it's an easy way to get some free money with the help of your employer match. Get started here. As you start with your 401k or your IRA, then I want you to start doing your other investments on the side and figure out what you like better. Now, IRAs are a little bit different than 401ks. I'm still going to talk about them. But this is where start with your 401k, see what you like, see what you don't like, and see if there are better opportunities for you elsewhere. With the IRA, you tend to have more flexibility because an IRA is not through your employer. The IRA is something that you get to control yourself. So you generally have more investment opportunities. You have traditional IRAs and Roth IRAs that work the same way as a 401k. But with an IRA, you have the ability to be much more hands-on with your investments. You also have some IRAs that will allow you to invest in real estate because pretty much all 401ks and most IRAs will require you to invest that money somewhere, somehow in the stock market. But there are some exemptions in IRAs that will allow you to invest your money into real estate. So you have a little bit more flexibility there. And now it's just a matter of figuring out, is the tax deferred benefits with an IRA worth it for you or not? Now, again, I'm not a huge fan of the tax deferred retirement accounts because I like being able to control my investments and I like the ability to touch my investments and I like the ability to get the cash flow today. That's just the way that I look at it. So for me, those tax benefits are not necessarily worth it because I'm also a big fan of real estate investing, and real estate provides some of the biggest and best tax benefits that our tax code has to offer. And I can tell you this as an attorney who's not your attorney, but real estate allows you to, number one, generate cash flow on your investments because now I can go out and buy a property. I can buy a single family home. I can buy an apartment complex. I can buy a mixed use building, but I can buy this building that I will then rent out to other people. When other people live in or use my property, I will get rental income. Now, if I do it correctly, this rental income will pay for my expenses. It'll pay for my property taxes, my insurance, my mortgage, my maintenance fees, my management fees, and any debt if there is any, and then put some money in my pocket. Now, generally, this income that I get is taxable, but real estate has this special exemption called depreciation, which says that because your property is 1 year older, you get a tax write-off on your income. So now you might get to say, hey, IRS, I generated, say, $10,000 in income from this property, but then you get to subtract this depreciation. Now, the amount of money you subtract is going to depend on how big the property is, but this is where you hear of some very successful real estate investors making millions of dollars a year paying little to no money in taxes legally. It's because of the depreciation deduction. Because they made income, they have their money in their bank account, but then they get to tell the IRS, because my property is a year older, I deserve this write-off. Even if the property value is going up, you get to still take this depreciation deduction. That's what the tax code says. And so now you can generate money and pay little to no money in taxes legally. And then the second benefit of real estate investing on the tax side is, let's assume that you buy a property for $100,000 and you own this property for a number of years. The area begins to boom, and now this property is worth $200,000, and you sell it. You just made $100,000 of profit. Now, generally, again, if you made $100,000 by selling an investment, that's taxable income. But with real estate, you have another tax deduction. This is called the 1031 exchange, which says you made $100,000 in profit by selling your property. If you take all of this $200,000, and this can be any amount of money, but if you take all this $200,000 and now you go out and buy a bigger property that's going to pay with more cash flow, you don't have to pay a penny in taxes today. And you can keep doing this again and again and again every year until you die and never have to pay a penny in this capital gain appreciation taxes. So now you bought a property for $100,000, sold it for $200,000. Then you could do it again. You buy a property for $200,000, sell it for $400,000. You sell that for 400,000 or 800,000. Now you keep flipping and flipping and flipping, and pretty soon, a number of years later, you're now in the millions of dollars. And it all started with your small $100,000 investment. Now, it's not always going to be sunshine and rainbows. There's a lot of headaches that are involved with real estate investing, but that's the idea, that you can get a lot of tax breaks with real estate investing. So now you have the tax deferred retirement accounts, which are the most accessible way for somebody to start investing. And this is where I would recommend that pretty much everybody start, because it takes the least effort. So get started here. But what I want you to remember is that this is not where your retirement planning should end. Even if you have a 401k and an IRA, I still want you now to invest in addition to that into the taxable retirement accounts, because now this is where you're going to be able to build true and real wealth. Most people assume that, I'm putting some money into my 401k, I'm getting my employer match, I'm all set, I'm ready for retirement. Well, you're going to be in for a rude awakening, because that's not going to be enough. You are going to have to invest your money yourself if you want to be able to retire wealthy and be able to live your life the way you want financially. So now, what is a taxable retirement account? Well, the first option, which I just talked about, is real estate. Now, the pros with real estate are everything that I just discussed. You get the tax benefits, you get the cash flow, you own a hard asset. But the cons with real estate are, it takes a lot of money to start investing in real estate. If you have $5,000 to invest, it's going to be very difficult for you to go out and buy a property yourself. Now, that doesn't mean that you can't get exposure to real estate, because if you have a few $1,000s, you can invest in crowdfunded real estate. You can invest in real estate syndicate deals, which means essentially you are getting exposure to somebody else's real estate deal. The way that you can do this is go to any real estate investor conference in your area. They happen all around the country. There's always going to be investors, developers there looking for money. Always. People are always looking for money to fund their deals. And if you invest in one of their deals, you're going to get a small piece of ownership in somebody else's deal. And if that deal grows and makes money, you're going to get your share of the profits. Of course, there's risk. You're never guaranteed to make money when you invest, but that's one way for you to get exposure to real estate without owning the real estate and buying it all yourself. One way to get started. The second way that you can invest your money into taxable retirement accounts would be through the stock market. Now, just like with anything else, there's a lot of different ways that you can do this, and you can go from very simple to much more complex. And if you just want to get started on the simple side, you can be a passive investor in the stock market. And this is where I believe that 90 to 95, maybe even 98% of Americans should be, because as a passive investor, what you're doing now is you're going to set up a system where every week or every 2 weeks or every month, every time you get paid, some money is going to automatically be invested into the market. And you're not investing in individual companies. You're not investing into Amazon or Tesla. You are investing in America. Now, all you got to do is every time you get paid, you're just going to buy a little bit more of America, period. And the way this works is you are going to buy some ETFs or index funds. These are funds that give you exposure not to one company, but to a group of companies. For example, I'm not telling you what to invest in, just an example. You can go out and invest in something like VTI. VTI is an ETF that gives you exposure to the total stock market. It's called a total stock market ETF. So now when you go out and you invest in that one ETF, you're getting exposure to our stock market. Well, what is in the stock market? The companies that make America, America. The big American companies, that's what's on the stock market. So now when you buy VTI, you're buying a piece of the stock market. Another one is SPY. SPY gives you exposure to the S&P 500. What is the S&P 500? Well, it is a group of the 500 largest companies on the stock market. So when you go out and you buy one share of SPY, you're buying a little piece of the 500 largest companies on the stock market in America. So now, if you were to build an ETF portfolio or an index fund portfolio, every week or every 2 weeks, or every month, some of your money is going to be pulled out of your checkings account when you get paid, and it's going to automatically be invested into America. Now, over the years, because it's not something you're going to do for 6 months, you're going to do this for years, if not decades, you're just going to keep buying a little bit more of America. That way now, as the American economy grows, your investment portfolio also grows. That's what passive investing is. I do passive investing. I have two strategies when I invest my money. One is passive investing, where every week I have some money that leaves my checkings account and is automatically invested. Now, I invest into a lot of different types of ETFs. I invest into cash flow producing ETFs, to value ETFs, into emerging market ETFs, into innovation ETFs. So I have a whole portfolio of ETFs that I invest in, but you just got to get started. The mistake that so many people make is not that they invest their money into the wrong sector or into the wrong industry or into the wrong group or into the wrong expense ratio fund. It's that they never start investing. And once you get started, guess what? You can always adjust your investment portfolio. You can always adjust your ETFs. You can always adjust your ratios. But you can't adjust getting started. So you got to get started first. So now I have this passive strategy that works for me. And then I also have an active strategy. Now, active strategy is now where I'm investing into individual companies. This is a lot more work. This is where most people think I'm going to find the next Amazon and I'm just going to throw my money into that. Or you try to find the next Tesla and you try to throw your money into that. For me, I'm looking for what I believe are good companies that are undervalued that I want to hold on to for the long term. And this isn't a guessing game. This is much more of a research intensive game where I like to research companies, and researching companies is more of the feeling side. This is now I'm looking at who's running the company. What is the product? Do people like the company? What's the sentiment around the company? And what's the barrier to entry? This is what Warren Buffett calls a moat. Is it really hard for a competitor to come in and take this company's spot? Or is this company a real behemoth and they have a real brand recognition and a name recognition that's going to be very hard to compete with? Once you figure that out, then you get into the financials. You're digging into the balance sheet. The balance sheet is essentially the net worth statement of a company. You look at the assets and you look at the liabilities. What do their balance sheet look like? What do their assets look like? What do their debts look like? Then I look at things like the income statement, the profit and loss statement. How much money did this company make last year, the year before that? What are their operating costs? Are they rising? Are they shrinking? If they're rising, why are they rising? Are they rising because they're investing a lot more in their company? Or are their operating costs rising because the cost of doing business is rising? And so you have to start asking and start looking into these numbers. Then you look into the cash flow statement, which is how is money flowing through the company? What is this company doing with their cash? Are they being smart with their money, or are they just getting rid of this cash and giving it away to shareholders too early? So these are the now analytical questions that you ask when you want to invest in a company. And again, you don't have to do this. Most people shouldn't be doing this. This is something that you got to be interested in. I like researching companies. I'm a money nerd, right? I'm a weirdo. I like doing that. To me, I enjoy it. So I don't mind doing it. But if you don't like the idea of learning how to do that, if you don't want to do that, if you don't want to spend the time to do that, if you don't have the time to do that, it's okay. You don't got to worry about doing it. You don't have to do that. The passive system is a great strategy that has been proven to build wealth decade after decade after decade. It doesn't mean that your investments are going to always go up. We see America go through recessions. We see our stock market go through market crashes. But if you invest long enough, you would have made money over the last century. And this is where now understanding, if you want to build wealth, you got to understand what your options are. The most accessible option is your retirement accounts. Get started there, but do not stop there. Your retirement accounts are not going to be enough for you to be able to live your life wealthy. Then, once you start there, you start doing the taxable accounts, stocks and real estate. And now you can make the third decision, which is, well, are these taxable accounts good for you, bad for you? It's okay if they're good. It's okay if they're bad. You just got to figure out what is the right strategy for you. And then, as you start building your investment foundation, that's when you can start looking at alternative types of investments. Now, this could be things like investing in startups. This could be things like owning a little bit of gold. This could be things like investing in potentially cryptocurrency. This is where now you can start looking at more of the speculative type of things, but you don't want to jump into these speculative investments until you built an investment foundation base. So now you start building your investment base. You have the retirement accounts, you have the taxable accounts, the non-taxable accounts, and now you can look at other things. I like investing in startups. I'm an entrepreneur. I like working with other entrepreneurs. I like researching these types of companies. I like investing in these companies, but it's very risky. Investing in startups is, well, you're going to lose money. 8 to 9 out of 10 startups will fail or go bankrupt within the first 5 years. Statistics tell us that. So if you were to go out and invest in a handful of startups, most of them will fail. The goal is that you're going to hit one that will make up for all the losses. Will that happen? Who knows? But that's part of the game. I think it's fun. I also like the financial potential upside with it, and it's a learning game for me. It's something that I enjoy doing. Besides that, I also invest in cryptocurrency. Now, I have use with cryptocurrency. I've talked about how I use cryptocurrency to pay some of my contractors that are overseas. I like the power of the blockchain, but there's a lot of people that jump into cryptocurrency thinking they're going to get rich by buying some cryptocurrency and having it just pop overnight. That's why you see such huge volatility in cryptocurrency. That's why you see some people make a ton of money in cryptocurrency. And that's why you see most people lose their money in cryptocurrency. So if you're going to invest in cryptocurrency, number one, make sure you can lose all that money. You're okay losing that. But then second, also understand what is it that you're buying? Are you comfortable with that investment? And are you comfortable investing in it for the long term? Number three, you can also look at owning precious metals, something like gold. I own gold. Gold makes up a small piece of my portfolio. It's about 2% of my entire investment portfolio. Why do I invest in gold? I look at it like a way to save hard money. If I were to go out and take $10,000 worth of gold and $10,000 worth of cash and bury it in my backyard today, my theory is that 10 years from now, the gold is going to have more buying power. So I own a little bit of gold, but it's not a huge piece of my portfolio. My gold doesn't generate me any cash flow, and I don't sit here and monitor the price of gold. It's just an alternative way for me to save money. It's another small piece of my investment portfolio. So now, when you build your investment portfolio, understand the investments that have been around a long time, that have been proven to build wealth. Make that the bulk of your investments, and then as you master that, you can start looking at other alternative investments, but start with the things that have been proven, stocks and real estate, and then you can start diversifying into some of the other asset classes as well. Your 20s are a time when you first start making money, and it's very common and normal to be dumb with your money because, well, it's the first time you ever make money. So now you want to go out and buy the nice things. You want to start spending money. You want to start going on vacation. You want to start buying a nice apartment. You want to get a nice car, and you want to just start exploring and enjoying life because you're finally out of school and you're finally making some money. But then come your 30s. And now you think this is going to be the time that I'm going to become wealthy, and an interesting thing happens in your 30s. First, this is around the time where a lot of people start to get married. You want to start settling down. Now, if you haven't gotten married yet, or if you are married, you know getting married is expensive. Not just because it costs money to file the court work, but because weddings are expensive. Now, I come from a traditional Indian family where Indian families and Indian weddings are extremely expensive because Indian weddings don't last 8 hours. Indian weddings last a week, if not longer. So, very expensive to get married. Then you consider having kids. Kids are also expensive. Now, I don't have any kids yet, but I have a lot of friends who have kids, and I hear about the financials of having kids, and having kids is expensive. Then you want to buy a home, if you haven't already. Buying a home is expensive. You need money for a down payment. You need money for the upgrades. You need money for the maintenance. You need money for all the nice things and the furniture that you want to put in the home. And then you start thinking about your college fund for your kids. And then you start thinking about building wealth for yourself and your wife or your husband. And then you start thinking about planning nicer vacations. And now because you're older, you also want to eat at nicer restaurants. And now because you're older, you want to have these fancier parties, go on these fancier dates. And now because you're older, you also want to drive a older person car. And now because you're older, you also want to have the nicer clothes so you look a little bit more professional when you go out. And now all of a sudden you're in your 30s. You're establishing yourself in your career. You're making okay money. But if you don't have a plan going into your 30s, it is going to be very difficult now all of a sudden to start building wealth and managing your money because life happens. And life is expensive. And people have a lot of babies. And every baby is going to have a baby shower. And every baby shower is going to have an expensive gift that you got to give. So if you don't have a plan going into your 30s, it's going to be very hard to build any wealth in your 30s, which is why so many people in their 30s are still struggling financially. And that's why now, if you want to become wealthy, the first thing you got to do is you got to build a plan for your money. Now, I know a lot of people out there are saying, oh, you just got to make more money. That's going to fix your problems. But the reality is, we've seen this statistically, is when you make more money, without having a plan, you dig yourself into a bigger financial hole. How do we know this? Well, just look at people who won the lottery. People have won millions and millions of dollars. Yet the majority of lottery winners end up broke or bankrupt within 5 years of winning the lottery. Why? It's not because millions of dollars weren't enough. It's because you don't have a plan for your money. And this is where the first thing you have to do is be comfortable and okay with the money that you have right now. And that starts by making a plan. Now, one of the simplest things that you can do is follow something like my 75, 15, 10 plan, which says for every dollar that you earn from here on out, 75 cents is the maximum that you can spend. And that includes gifts for baby showers. 15 cents is the minimum that you're investing. 10 cents is the minimum that you're saving. Now, you're going to be saving money up until you can hit your savings goal. And your savings goal is going to be somewhere between 3 months to a year's worth of expenses. So figure out what your monthly expenses are. Take that number, multiply it by 3, multiply it by 12. That's the range of how much money you want to save. If you don't have a big risk tolerance, if you really like to be on the more cautious side, then you can save 6, 9, 12 months worth of expenses. If you want to be more of the risky side, you don't mind having less savings, then you can save 3 to 6 months worth of expenses. But now, once you figure out how much money you got to save, work to save that money. Once you save that money, take the 10% that you were allocating towards your savings, stop saving, and take the money and invest it. And the reason why I want you to invest that money instead of spend that money is because your wealth, your richness, your financial freedom comes from your investments. It doesn't come from your savings. It doesn't come from which car you drive or what home you live in. It comes from your investments. The more investments you have, the wealthier you will become. So I want you to reallocate that money towards your investments. Now, you can invest this money into stocks. You can invest this money into real estate. You can invest this money into your own self, into your own financial education. You can invest this money into your business. You can invest this money to pay down some of your debt. There's a lot of ways that you can invest this money, but the key is that you're going to put this money to work. That way it can make you more financially free. Paying down your debt will make you breathe easier. But if you want to be completely financially free, you need assets. You need investments that are going to pay you, because when your investments are paying you enough to cover your expenses, now you're financially free and you don't have to worry about money. If you have a dividend portfolio, dividends are cash flow the stocks give you that are paying you enough to cover your mortgage and cover your expenses, you don't got to worry about money. You don't got to worry about clocking in tomorrow. Now, that doesn't mean you shouldn't go to work, but you don't have to stress the same way about money that you would be if you didn't have that. So the goal is to own enough investments that will cover your lifestyle. But in order for you to do that, you have to be able to invest your money. And that means, number one, wherever you are right now, no matter how much money you're making right now, you do not spend more than 75 cents of every dollar that you bring in, period. Now, you might be saying, but Jaspreet, my best friend is getting married next month. I need more money for a gift. I need more money for a bachelor party. I need more money for this or for that. This is life. There's always going to be things happening. What happens in your 30s is people keep popping out babies, people keep getting married, and people keep having expensive parties at these overly over-the-top restaurants that are expensive. And what you realize is you start going to these nicer restaurants, and you start getting smaller portions of food. It still makes no sense to me. But that's what happens in your 30s. You pay more for less food, and you pay for a lot of people's babies. That's the 30s. That is life, which is why now you got to stop with the exceptions, and now you got to start being smart with your money today. That means now 75 cents is the maximum that you can spend. Now, if you want to be able to spend more, because now you want to have nicer things, you want to be able to have a bigger lifestyle, okay, that's fine. Nothing wrong with that. You're either going to have to A, invest more so you have more income coming in from your investments, or B, you're going to have to work to earn more money. Now, going back to what I was saying just a minute ago, statistically, when people make more money, they dig themselves into a deeper financial hole. Why? Because we're not given any sort of financial education. Most of us don't know what to do with our money. Most of us don't know what to do with $1 million if we were given it. Most of us don't know what to do with an extra $10,000 a year. And the quickest way to increase your wealth is next time you get a pay raise, don't inflate your lifestyle. Next time you get a pay raise, don't raise your lifestyle. Make more money. That way you have more money to invest. Now, I'm not saying you got to live like you're broke forever, but you got to go through this period. I call it a decade of sacrifice, where you're going to be working to do two things: earn more and spend less That way you have more money to invest. Now, it doesn't sound like a lot of fun, and cutting back isn't the most fun thing to do, but if you can make it a challenge, it becomes more fun. But it will allow you now in your 30s to build way more wealth. That way, once you hit the 40s, because guess what? The clock is going to keep ticking, years are going to keep going, and time is going to keep running. And eventually you're going to become 40. You're going to hit your 40s. And now either you can be in the same situation that you are right now, or you can work right now to put in the sacrifice to build that wealth. That way now once you hit your 40s, you've built a solid investment fund, you've built a solid investment portfolio that gives you a lot more financial freedom. And now you can start spending more money because you can afford to. And now you can start going to parties and be a lot more comfortable spending money. But that requires you to put in that sacrifice today. Either you're going to put in the sacrifice today or you're going to pay the price tomorrow. I mean, the choice is ultimately yours. But the reality is, if you want to be able to manage your money like the wealthy, the first thing you have to do is you got to be able to make the sacrifice to live a little bit smaller and then work to earn more money. But then when you work to earn more money, don't work to earn this money now that we can drive a faster car or have a bigger home and go on these nice vacations or pay for the small portions of food at these expensive restaurants. Work to earn more money right now. That way you have more money to invest. Period. Put in that work to invest your money first. Make yourself rich before you make everybody else around you rich. And what that defines to in number terms, whether it is $100,000 or $500,000 or $1 million, that's subjective. That's for you, depending on what your lifestyle is and how much money you need. But you have to be willing to put in that work right now. That way you can actually build that wealth. And this is where now you want to be looking at your money. And the simplest way to do this, I want you to take a piece of paper. I started doing this with everything, is when a new month starts, take a look at last month's finances. That means I can do this on a Google Sheet. You can do this on a piece of paper, whatever you want. You take a look at how much money you brought in. This could be money from your job. It could be money from your business. It could be money from your investments. Take a look at all the money you brought in. At the top, write the income. Then write the total money that came in. Then write down where that money went. So you can write how much money you saved. Write down how much money you invested. And then write down all of your other expenses. How much money went to eating out? How much money went to groceries? How much money went to traveling? How much money went to housing costs? How much money went to gifts? And how much money went everywhere else? Now you write down your expenses. Now, as soon as you do this, you are immediately going to find ways to adjust and improve how you're using your money. How do I know this? Because as soon as you see how much money you're spending on a bunch of expensive meals that aren't feeding you properly, you're going to immediately want to make changes because it's going to be staring back at you in your face. So start quantifying where your money is going and take a look at it. And now when you look at it month over month over month, you're going to see how much money you're bringing in, if your income's growing, staying the same, or falling. You're going to see how your expenses are doing. Are you spending more money, spending less money, spending the same amount of money? And see where your money is actually going. Sometimes, yeah, there's going to be months where you have to spend more money. That's life. But if you don't have to spend money, do you have to spend money? And this is where right now, your job as a financially smart person is to stop following what everybody else does, because the reality is most people in the 30s are still broke. Even if they're driving a BMW, they're still broke. This is where now you want to be the person that's not broke driving a BMW. You want to be able to afford the BMW and not have to stress about putting premium gas in the car. It blows my mind how many people have BMWs or expensive pickup trucks that complain about gas prices. If you're complaining about gas prices, you shouldn't have that car to drive in the first place. If you're complaining about the premium gas price, you shouldn't be driving a car that takes premium gas. Period. And this is where, if you want to have the nice things, cool. Just make sure you can afford the nice things first. And the final thing that you have to do in your 30s, you have to do this right now if you want to ever have a chance to ever become wealthy, is if you have a partner, a wife, a husband, a spouse, you got to sit this person down and get on the same page financially. And I get comments about this all the time. Jaspreet, I'm working hard to build my wealth, but my wife keeps spending all my money. Or, Jaspreet, I'm working hard to build wealth, but my husband keeps buying all these stupid cars. What do I do? Talk to them. Can you do something? And this is where now you got to sit down with your spouse and have an honest conversation about money. Show them my videos if you want. But you got to have an honest conversation about money, about where you are today and where you're trying to go. And the way that you win in this conversation, I'm going to tell you from personal experience here, is not to say, hey, wife or husband, we're going to cut back on expenses because cutting back is fun. That never works. It's, hey, husband or wife, we are going to make some sacrifices today. Work with me on this because I think you're going to be able to have even more fancy handbags 5 or 10 years from now because we're going to put this plan together and we're going to work together to build more wealth. That way you can buy whatever handbags you want and not have to stress about the price. So now you're working towards a goal where, okay, you want some nice things. That's fine. That's very common in a relationship where one person likes spending, the other person doesn't. Opposites attract for a reason. Very rarely do you see two people in a relationship that are both like, you know what, we're going to cut back on expenses or we're going to earn more money. It doesn't work like that. One person wants to make more money and one person wants to spend more money. It's just how it works. Now, in order to get on the same page, you got to get together on the same goals. It's easier to align on the goals and then put in the sacrifice together. And this is where you're going to have to be honest with one another and come together with a game plan and work together to come up with an actual system to build wealth together. Hey, wife, husband, we're going to work together. That way we can invest more. That way we can save more. That way we can build a financial future. That way we can build a college fund for our kids. And as we start to do this, we're going to be able to spit off this much money every month for fun and discretionary items and more handbags or whatever it is that you want. And then in X number of years, we're going to be able to have more fun, go on more vacations and do this type of stuff. But I need you to work with me. That way we can actually make this happen. And this is where you also want to understand and remember that if you're in your 30s, you are still young. You have so much time ahead of you. If you're in your 30s, if you're 35 years old, you are young. This is still the time for you to be aggressive. There's a lot that you can do. It kills me when I hear people who are 35 years old talk about how they're stuck in their careers or they're too established in this one industry and they cannot change. You are so young. If you want to make a change, do it. There's nobody stopping you but you. Now, you might feel like everybody's watching you. Your parents are watching you. Your in-laws are watching you. Your friends are watching you. Your cousins are watching you. Your coworkers are watching you. But who cares? This is your life. Everybody's going to judge you. The world is built to judge. That's just the way it works. Anytime I release a video on YouTube, people will judge. People judge no matter what you do. People will judge based off of what clothes you wear. People will judge based off of how much facial hair you have. People will judge based off of what pen I use. People judge me based off of what tea that I drink. People will judge you for everything that you do. People will judge you if you stay at your job. People will also judge you if you leave your job. It's just the world. So now you might as well make it matter. You might as well make it worthwhile. So if you want to make a change, if you feel like you're unhappy financially, go out and make a change. That might mean making sacrifices with your car, making sacrifices with your home, making sacrifices with your vacations. It might be making sacrifices with the career that you're doing. But you are the one that's in control of that. You're the one that's in control of your life. And if you're constantly worried about what other people think, it is going to be impossible for you to ever achieve any real financial freedom. And the one thing, I mean, there's a lot of things that I can credit, and I'm very fortunate to be where I am, and I know that. But I would say the main mindset thing that allowed me to be where I am today is the fact that I was stupid. I never cared what people said. No matter how many dumb things I did, everybody told me that I was being dumb. But I had that hard head where I just kind of followed what I thought was right, no matter what. So please, if there's one thing that you get out of this video, it is to stop working to please other people and work to please yourself. Because the reality is nobody else is going to be the one that's dealing with your bills. Nobody else is going to be the one that's paying for your kids to go to college. Nobody else is going to be the one to pay for your spouse to have the nice handbags or to pay for your family's vacations. That's you. Now, everybody else is going to talk no matter what. Everyone else is going to be talking about what you're doing or what you're not doing or what you should be doing. So give them something good to talk about. So now, if it's your responsibility to take care of your family, take care of them. Take care of yourself financially, take care of your family financially, because that is your duty. It is not your duty to worry about what everybody else thinks, because everybody's got an opinion and everybody's got something to say. It is your duty to take care of yourself, your family, and your community. And when you're in your 30s, you are young. You can still be aggressive. You can still go out and do bigger things. You can still go out and make big changes, but you have to be the one to go out and do it. So now, If you are in your 30s and you want to build wealth, the first thing you got to do is figure out how far are you from becoming wealthy. Then number 2, put a plan in action to actually become wealthy. That means now take a look at how much money can you put aside every single month? How many years do you have to work ahead of you? 3, put a plan in action to actually invest this money. Put a plan in action to earn more money if you need to. Put a plan in action to spend less money if you need to. And then think a little bit bigger. This is the minority mindset. We're not here to think like everybody else. If you want to think like the majority, go watch any other channel. The whole idea here is to think different, that we don't have to live an average life, that way you can live a bigger life, but that means you're going to have to start thinking differently than the majority of people. Now, if you want to start thinking differently than the majority of people, that means you're also going to have to do things a little bit differently. That means you might have to make a little bit more sacrifices. That means you have to work a little bit harder. That means you might have to work a little bit smarter. But it will also allow you to live a life that most people dream of. Now, again, most people are going to talk and judge and hate on whatever you do, no matter what you do, whether you don't change or whether you do change. And so now, if your goal is to live big, at least give everybody something to talk about, something good to talk about, because now if you stick with it, you're going to be able to earn more money. And now you know what to do with this money, because now you can take this money and invest it and build your wealth, build your family's wealth, and take better care of your family. And now people have a better reason to talk, because now you can take better care of your family. And it doesn't matter because their opinions are not paying your bills. Your money is. And now you can have the nicer things and have more financial freedom because you work to earn it, and you're not going to complain and blame everybody else. You're just going to continue to put your head down, get your money, that we can take better care of yourself, your family, and your community. I knew I wanted to be rich when I was a kid. Not because I was some greedy, money-hungry child, but because I just wanted to buy my dad's time back. My parents are immigrants from a state in India called Punjab. And the way it works is when your parents come from a different country, a poorer country, and then to come to a place like America, now not only